I'm Ray Dalio. In 2008, I was the god of systematic investing. Everyone worshipped my principles until that morning when I realized I'd lost $4.7 billion. But the money wasn't the scary part. That day, I discovered that the world I thought I controlled was a complete lie. Today, I'm going to tell you about that day, because everything changed for me then. And if you're going to survive, you need to learn what I learned. This isn't just a story about losing money. This is about how a man became enslaved to the very system he created, and how the thing that saved him was the one thing he was most afraid of losing. It was the end of 2007. My Bridgewater Associates was managing $150 billion. Everyone called me the master of markets, because I had a system, a perfect machine that explained everything, predicted everything, controlled everything. I'd arrive at the office at 5 a.m. every morning. My first task was reading the overnight reports, every economic indicator, every market movement, every geopolitical event. It was all inside my system. My algorithms were smarter than humans, or so I thought. That morning came like any other. March 15th, 2008. News of Bear Stearns' bankruptcy had spread. Markets were bleeding. But I was calm. Because the system had foreseen this. My system knew everything. But the real shock was about to happen. When I entered the morning meeting, my team was ready. Charts, tables, analyses, everything was organized. The system said Bear Stearns' collapse was just the beginning. It had calculated that Lehman Brothers would share the same fate. Great, I said. Let's short them. That's when I noticed the expression on my assistant Sarah's face. She was worried. Ray, she said, there's something. I looked at her. She'd been working with me for 8 years. I'd never seen her this tense. There's an inconsistency in the position calculations in the system. My heart stopped beating. What do you mean? The risk models, they're contradicting each other. This is exactly when all of Ray Dalio's principles started to collapse. When I looked at the numbers Sarah showed me, my world shook. My system, my perfect, infallible system, was giving both buy and sell signals simultaneously for the same stock. This was impossible. For 15 years, I had perfected this system, accounting for every scenario. But now, at the most critical moment, the system had gone insane. There must be an error, I said. Check the codes again. The team dissected the system for 3 hours. The result was the same. The system continued giving contradictory signals. That day, I realized for the first time. Control was an illusion. You haven't seen the biggest surprise yet. Bear Stearns' collapse was just the beginning. In the following days, the system became even more complex. Up one day, down the next. There was no logic to it. I stayed in the office nights examining the codes. Every line, every algorithm. Where was the error? How could I have been so wrong? Then I understood. The problem wasn't the code. The problem was me. When I designed my system, I hadn't accounted for one thing: human nature. Markets weren't just about numbers, they were about people. And when people got scared, they acted irrationally. When Bear Stearns collapsed, everyone panicked. They didn't act rationally. They didn't behave the way my system predicted. And I was human too. Wait a minute. Don't miss the detail Ray Dalio noticed. On March 21st, when I returned to my office, there was a note on my desk from Sarah. Risk management meeting canceled. Emergency. I ran to the conference room. My 15-person team was inside. They were all looking at me. What's happening? Chief Risk Analyst Mike stood up. He had a folder in his hand. Ray, we checked the system's latest calculations. Our investment in Lehman Brothers. He stopped. What is it, Mike? We could lose $4.7 billion. Everyone in the room fell silent. $4.7 billion. The biggest potential loss in Bridgewater's history. You won't believe it, but this decision changed everything. That night, I didn't go home. I sat in my office in the dark, just thinking. How would I explain this loss? To investors, to my employees, to my family? Would saying my system was wrong be enough? The weight of responsibility was crushing me. I had built this empire on the promise of systematic perfection. My clients, trusted me, because I claimed to have eliminated human error from investing. But here I was, the human error incarnate. I walked to the window and looked out at the city. Millions of people sleeping peacefully, unaware that one man's arrogance might cost billions. I thought about my childhood, growing up in Jackson Heights, Queens. My father was a jazz musician who taught me that improvisation was an art, but I had rejected improvisation. I wanted certainty. I wanted control. The irony wasn't lost on me. Then, at midnight, the phone rang. It was Warren Buffett. "Ray," he said, "is what I'm hearing true?" I remained silent. "Son, listen to me. I've made big mistakes too. In 1975, I nearly bankrupted Berkshire. But you know what I learned?" "What, Warren?" "Losing is part of winning. Systems can't be perfect." "Because we're not perfect." His words hit me like lightning. Warren Buffett, the man I had always admired, was telling me that imperfection was not failure. It was humanity. "The difference between successful people and others," he continued, "isn't that successful people don't fail. It's that they learn faster from failure." After hanging up, I sat there until dawn. The city slowly came alive below me. People heading to work, trusting that the financial system would hold, trusting people like me to be responsible with their futures. That's when it hit me. My obsession with being right had made me dangerously wrong. Everything you've seen so far is nothing. The next morning, I called an emergency meeting. Not just my team, but every senior person at Bridgewater. 75 people crammed into our largest conference room. I walked to the front. No PowerPoint, no charts, just me. "I've been thinking all night," I began, "and I've realized something that's going to sound crazy." Everyone leaned forward. "We've been building the wrong system." Murmurs filled the room. "For 15 years, we've tried to build a system that's never wrong. But what if instead we build a system that's brilliant at being wrong?" Sarah raised her hand. "What do you mean?" "What if we designed our system to fail gracefully? What if we anticipated our own mistakes and planned for them?" The room was silent. "Think about it," I continued. "Every great system in nature has redundancy, adaptation, recovery mechanisms. But we've been trying to build a system that never needs to recover because it never fails." Mike, our risk analyst, spoke up. "But Ray, if we designed for failure, aren't we essentially planning to lose money?" "No, Mike. We're planning to learn money. There's a difference." I grabbed a marker and drew on the whiteboard. Traditional system, be right, avoid mistakes, perfect predictions. Then I drew another diagram. New system, expect mistakes, learn from them quickly, adapt faster than markets change. Everyone thought they knew the truth, but the real shock was coming. That day, I wrote what would become the foundation of everything we do. The principles of radical transparency. First principle, no hiding mistakes. Every error gets documented, analyzed, and shared. Second principle, pain plus reflection equals progress. Every loss teaches us something valuable. Third principle, the biggest risk is not taking any risk in a world that's changing so fast. But the hardest part wasn't writing these principles, it was living them. 2 weeks later, we had to face our investors. I walked into a room full of angry billionaires who had lost money because of my system's failure. I could have blamed market volatility. I could have blamed unforeseen circumstances. Instead, I did something that shocked everyone. I told them the truth. "Gentlemen," I began, "I failed you. My system failed, but more importantly, my thinking failed. I designed a system that was supposed to be perfect, but perfection is the enemy of adaptation." The room was deadly quiet. One investor stood up, a man who had trusted me with $2 billion. "Ray," he said, "are you telling us that you don't know what you're doing?" I looked him straight in the eye. "That's exactly what I'm telling you, and that's why, from now on, we're going to be the best in the world at not knowing what we're doing." Some investors laughed. Others looked confused. But I continued. "The old Ray Dalio pretended to have all the answers. The new Ray Dalio admits he has questions. The old system tried to eliminate uncertainty. The new system embraces uncertainty as the only certainty." But here's where the story gets interesting. 3 months later, I received a call that would validate everything. It was from Paul Tudor Jones, another legendary hedge fund manager. "Ray," he said, "I heard about your new approach. I want to learn from your failures. Can you teach me how to be wrong better?" That call led to something unprecedented in our industry. We started sharing our mistakes with other hedge funds, not our successes, our failures. We created what I called the Failure Database, a comprehensive catalog of every major investing mistake made by the world's best investors. Soon, other funds were contributing. Soros shared his currency miscalculations. David Swenson from Yale contributed their endowment mistakes. Jim Simons from Renaissance Technologies added their algorithm failures. We had created something revolutionary, a systematic approach to learning from collective stupidity instead of individual brilliance. The results were extraordinary. Funds that participated in our failure-sharing network began outperforming those that didn't by an average of 4% annually. Why? Because they were making different mistakes, not better decisions. They were failing in ways that had already been documented and analyzed, so they could fail faster and recover quicker. Here's what nobody talks about in finance. Success isn't about being right more often. It's about being wrong in ways that don't kill you and right in ways that make you rich. Most investors try to increase their hit rate. They want to be right 80% of the time instead of 60%. But that's the wrong metric. The right metric is the asymmetry of your wins and losses. I'd rather be wrong 70% of the time with small losses and right 30% of the time with massive gains than right 80% of the time with small gains and wrong 20% of the time with devastating losses. This principle completely changed how we structured our investments. Instead of trying to predict which stocks would go up, we started building portfolios that could survive being wrong about almost everything while still capturing the big moves when we were right. We developed what I called the barbell strategy. On one end, extremely safe investments that would never lose much money. Government bonds, high-grade corporate debt, cash, equivalents, boring stuff that preserves capital. On the other end, extremely risky investments that could lose everything but had unlimited upside potential. Emerging market stocks, commodity futures, currency speculation, startup investments, nothing in the middle. No moderate risk, moderate return investments. Why? Because moderate investments give you moderate results, and moderate results compound into mediocrity. The barbell strategy gave us something much more powerful: anti-fragility. Most portfolios are fragile. They break under stress. Some portfolios are robust. They survive stress but don't benefit from it. But an anti-fragile portfolio actually gets stronger from chaos and uncertainty. When markets crash, the safe side of our barbell protects our capital. When markets boom, the risky side delivers exponential returns. When markets are volatile, both sides benefit because volatility creates opportunities that stable markets don't provide. The key insight was this: in a world of infinite possibilities, the most dangerous thing is thinking you know what's going to happen. The safest thing is building a system that benefits from being wrong about what's going to happen. But implementing this wasn't easy. It required fundamentally changing how we thought about risk. Traditional finance says diversification reduces risk. We said concentration in the right areas increases anti-fragility. Traditional finance says correlation goes to 1 in crisis. We said correlation is irrelevant if you're positioned for chaos. Traditional finance says volatility is risk. We said volatility is opportunity for those who are prepared. The transformation took 2 years. We had to rebuild our entire risk management system. We had to retrain our analysts to look for what could go wrong instead of what would go right. We had to restructure our compensation to reward good decision-making processes rather than good outcomes. Most importantly, we had to change our culture from one that punished mistakes to one that punished not learning from mistakes. The cultural change was the hardest part. Wall Street is built on ego and certainty. Admitting you don't know what you're doing is career suicide in most firms. But we made it career suicide not to admit when you were confused or uncertain. You still haven't seen the most important part. By 2010, 2 years after the crisis that nearly destroyed us, Bridgewater had become the largest hedge fund in the world. We were managing over $100 billion. But size brought new problems. When you're managing that much money, you can't just buy and sell stocks. Every move you make affects market prices. You become the market in some securities. This created a paradox. The more successful our system became, the less effective it could be. Our trades were so large that we were moving prices against ourselves. If we wanted to buy a stock, the act of buying it would drive the price up before we could accumulate a full position. If we wanted to sell, we would drive the price down before we could exit completely. We needed a different approach. That's when I discovered something that changed everything again. Instead of trying to predict individual securities, we started trying to predict the behavior of prediction itself. Let me explain. Every investor is trying to predict something. Stock pickers predict which companies will grow. Macro traders predict which economies will outperform. Currency traders predict which currencies will strengthen. But what if, instead of making our own predictions, we could predict what other investors would predict, and when those predictions would be wrong? This led to what we called meta-strategy, investing based on the predictable patterns of how other investors make predictions. For example, we noticed that momentum investors always overshoot. When a stock starts going up, they keep buying it even after the fundamentals no longer support the price increase. So we developed algorithms that identified when momentum was about to reverse and positioned ourselves accordingly. We noticed that value investors always undershoot. When a stock gets cheap, they buy it even before it's finished falling. So we developed systems that identified when value buying was premature and shorted stocks that looked cheap but weren't done declining. We noticed that fear and greed follow predictable cycles. Fear dominates during crashes, creating oversold conditions. Greed dominates during bubbles, creating overbought conditions. But the timing of these cycles isn't random. They follow mathematical patterns based on human psychology and information flow. The breakthrough came when we realized that markets aren't just about economics. They're about sociology and psychology. People make decisions based on stories they tell themselves about the future. And these stories follow predictable patterns. There's always a dominant narrative in markets. In the 1990s, it was, technology will change everything. In the 2000s, it was, real estate always goes up. In the 2010s, it was, central banks will prevent all recessions. Each narrative creates investment flows that persist long after the narrative stops making sense. The secret is identifying when a narrative is reaching its expiration date and positioning yourself for the next narrative before others recognize it. This isn't about being smarter than other investors. It's about understanding that all narratives eventually exhaust themselves and being ready for the transition. We started building models that tracked narrative exhaustion. How long had a particular story dominated market thinking? How extreme had the investments based on that story become? How much real-world evidence contradicted the story? When all three factors aligned, we knew a narrative shift was coming. What happened next validates everything I've told you. In 2020, when COVID hit and markets crashed 35% in 5 weeks, most investors panicked. They sold everything and hid in cash. But our system wasn't surprised. We had been tracking the narrative exhaustion of continuous economic growth for 2 years. The signs were everywhere. Corporate debt had reached historic levels. Stock valuations had disconnected from earnings. Central bank policies had created asset bubbles in everything from bonds to real estate to art. The dominant narrative was, nothing can stop this bull market. When narratives become that extreme, they're usually about to reverse. So when the crash came, we weren't positioned defensively. We were positioned opportunistically. We had been accumulating cash and building shopping lists of assets we wanted to own at lower prices. While others were selling in panic, we were buying at discounts. The result, 2020 became our best year ever. We generated 43% returns while the average hedge fund lost 8%. But more importantly, we generated those returns with lower risk than we had taken in the previous decade. How? Because we weren't trying to predict what would happen. We were positioned to benefit from whatever did happen. This is the core insight that took me 40 years to understand. Successful investing isn't about being right about the future. It's about being prepared for multiple possible futures and having systems that benefit regardless of which future occurs. Most people invest like they know what's going to happen. They buy stocks because they think the market will go up. They avoid bonds because they think interest rates will rise. They choose growth over value because they think innovation will continue to accelerate. But what if they're wrong? What if the market crashes? What if interest rates fall? What if innovation slows down? Their entire strategy collapses because it was based on a single prediction being correct. Smart investors don't make predictions. They make preparations. They build portfolios that can handle multiple scenarios. They create systems that adapt to changing conditions rather than betting on specific outcomes. They focus on managing downside risk rather than maximizing upside potential. Because here's what I learned from losing $4.7 billion. You can be wrong about a lot of things and still get rich. But you can only be catastrophically wrong once. The key is making sure that when you're wrong in small, manageable ways. And when you're right in big, transformational ways. This requires a fundamental shift in how you think about uncertainty. Most people fear uncertainty and try to eliminate it. Smart investors embrace uncertainty and try to profit from it. Uncertainty creates volatility. Volatility creates opportunities. Opportunities create wealth for those who are prepared to capture them. But you have to be prepared before the opportunities appear. You can't wait for the crash to build your cash reserves. You can't wait for the bubble to develop your bubble detection systems. You can't wait for the crisis to create your crisis response protocols. Preparation happens during boring times so you can profit during interesting times. That's the ultimate lesson from my 40 years of systematic investing. The best time to prepare for the next crisis is when everyone else thinks there will never be another crisis. The best time to prepare for the next opportunity is when everyone else thinks opportunities are scarce. The best time to build anti-fragile systems is when everyone else thinks the current system will last forever. Right now, in 2024, most investors think they have it figured out. They think artificial intelligence will drive eternal growth. They think central banks can prevent major recessions. They think geopolitical risks are manageable. History suggests they're wrong. Not about everything, but about enough to create massive opportunities for those who are prepared. The question isn't whether the next crisis is coming. The question is whether you'll be ready to benefit from it when it arrives. The most dangerous thing about success is that it makes you believe your own story. By 2015, Bridgewater was managing $160 billion. I was on magazine covers. Universities were teaching case studies about my principles. The world treated me like an investing god again. And that's when I almost made the same mistake I had made in 2008. I started believing I had solved investing, that my systems were perfect, that I could predict and control everything. The warning signs were subtle at first. My team started agreeing with me more often. Fewer people challenged my ideas. Meetings became more about implementation than debate. I was surrounded by smart people who had stopped thinking independently because they assumed I had all the answers. This is what success does to organizations. It creates echo chambers where dissent disappears and groupthink dominates. Everyone becomes invested in maintaining the story of success rather than questioning whether that success is sustainable. I caught myself making decisions based on ego rather than evidence. When a junior analyst questioned one of my strategies, I dismissed him instead of engaging with his concerns. When our performance started lagging, I blamed market conditions instead of examining our process. When competitors started copying our methods, I felt threatened instead of taking it as validation. These were exactly the behaviors that had led to my 2008 failure. The only difference was that this time I recognized them earlier. I realized I needed to institutionalize humility before success destroyed us again. So I created what we called red team exercises. Every quarter, we would take our highest conviction positions and assign our smartest people to argue why we were wrong. Not to play devil's advocate, but to genuinely try to prove that our best ideas were terrible. We would stress test not just our positions, but our reasoning. What assumptions were we making? What evidence were we ignoring? What narratives were we unconsciously accepting? This process was painful. Nobody likes having their best ideas attacked by their own team. But it was essential, because the market would attack those ideas eventually anyway. It was better to discover the flaws in our office than in our portfolio returns. The red team exercises revealed something disturbing. Many of our positions were based on outdated assumptions that we had never questioned. We were still fighting the last war, using strategies that had worked in 2008 but might not work in 2018. The financial world had changed, but our mental models hadn't kept up. Central bank policies had created conditions that had never existed before. Technology had accelerated information flow in ways that changed market dynamics. Globalization had created interconnections that made previous diversification strategies obsolete. We had to rebuild our systems again, not because they were wrong, but because the world they were designed for no longer existed. This is the hardest lesson for any successful investor to learn. Your edge doesn't last forever. What worked yesterday might not work tomorrow. What seems obvious today might be completely wrong next year. The only sustainable competitive advantage is the ability to constantly question everything you think you know and rebuild your understanding from scratch when necessary. Most investors never learn this lesson. They find something that works and stick with it until it stops working. Then they blame bad luck or market manipulation instead of recognizing that all edges eventually erode. The investors who build lasting wealth are those who regularly destroy their own certainties before the market destroys them for them. They embrace intellectual humility as a core competency. They treat their strongest convictions with the most skepticism. They build systems that assume they're wrong and protect them when they are. This mindset is counterintuitive. Everything in our culture celebrates confidence and punishes doubt. But in investing, doubt is your friend and confidence is your enemy. Doubt makes you careful. Confidence makes you careless. Doubt makes you question everything. Confidence makes you question nothing. Doubt preserves capital during bad times. Confidence destroys capital during good times. The most successful investment strategy isn't about being right more often. It's about being wrong less catastrophically and right more asymmetrically. It's about building systems that compound small edges over long periods rather than betting big on dramatic insights. It's about boring consistency rather than exciting genius. After 50 years of doing this, I can tell you that the secret to systematic wealth creation isn't complicated. Find edges that others can't or won't exploit. Exploit them systematically while they last. Constantly search for new edges while your current edges still work. Build systems that survive the transition from old edges to new edges. And above all, never believe that any edge will last forever, including the edge of knowing that edges don't last forever.